let's look at Hepburn. That's a very good question to review what we've been looking at in the past videos on how to consolidate statement of financial position. Right. So we'll take a few minutes, read the questions, and remember we're still going to use our method, which is 7 by 5. 7 steps, 5 steps. That's what we're going to use. And we'll start with step 1. And step 1 is about drawing the structure. So Hepburn acquired another company called Salter, and he only acquired 80%. On what date? On 1st of October 2013. Very important, because this date is critical for you to know whether it's during the year acquisition or beginning of the year acquisition. If it's beginning of the year acquisition, you won't need to worry about prorating, but if it's during the year acquisition, then you need to be careful to prorate the profit, especially when you are calculating the post-acquisition profit. When is the financial year? Financial year is 31st of March 2014. So automatically, this is a during the year acquisition. As you can see, 1st of October, 31st of March is not up to 1 year. So how many months of proration do we need to do? We need to take note of that. So we're going to talk about October, November, December, January, February, March. So we've got 6 months. So we need to take note of that. So this is 6 months post-acquisition. Now we have the structure. The next step is step 2. And step 2 is about consideration. So this is about structure. Please always follow your steps. And it's about consideration. Practice with these steps so that when you get to the exam, you're able to, because these are the things that will earn you marks, not even the consolidation itself. These steps will earn you a lot of marks. So consideration is what we want to do. What we understood is that Hepburn actually acquired this 80% by way of share exchange. So there's a share exchange, and it has promised to issue 5 of its own shares for every 2 shares in Salter. Right. So the first question is, how many shares does Salter have? When you go to the share capital of Salter, we'll see that Salter has one share capital of 150,000, and each share has a nominal value of $1. So which means Salter will have $150,000 divided by $1, and that equals to 150k shares. So that's the number of shares Salter has. So, but Hepburn acquired 80%. So 80% is equals to 0.8 multiplied by 150, and that will give us 120k. So that means only 120,000 shares were acquired by Hepburn. And if that is the case, the next thing is, how much did he pay for 120k shares? So what we learned was that it did not pay cash. It did not pay cash at all. Instead, what he paid was a share exchange. And you need to be careful anytime you have a share exchange. It was clearly stated that it issued 5 of his shares with 2 shares of Salter. So which means he used his own shares to pay. He used his own shares to pay. So which means he issued 5 of his shares for every 2 shares of Salter. Now he acquired 120k shares of Salter, which means he's going to have 5 times 120 over 2 to issue of his own share, and that will give us 300k shares. So he must have issued 300k of his own shares to pay of Hepburn. Please take note how we've done it. He used his shares to pay. Don't make mistake of saying 300k shares of Salter, because Hepburn is the one that acquired. So Hepburn is using his own shares to make the payment. And what is the value of his shares? The market value of its shares on that date of acquisition was $3 each. So which means the value of that consideration will be equals to 3 multiplied by That's $3 for each share multiplied by 300K. So which means the total consideration will be $900,000. So now we know that. But before I go into the next step, remember how this will be posted in the account, because it's issues of shares, and I spoke about different types of consideration in my previous video. In this case, the question has already told us that $1 is the nominal value of each share of both Hepburn and Salter. So which means that if $3 was paid for each share in terms of market value, $1 will go to share capital. So which means $300K goes to share capital. So you're going to credit share capital. The other one you credit to share premium, $600K. And the debit goes to investment in subsidiary, $900K. So this will be the entries. It's good to know this entry because especially these two will be important when we get to consolidation stage. Okay, so we'll go to step 3. And step 3 is about calculating the net asset at acquisition. So we need to calculate the net asset at acquisition. And here we need two things. We need the share capital at acquisition, and we need the retained earnings at acquisition. The share capital at acquisition remains 150 because it didn't tell us that any additional shares was issued. It didn't tell us any additional shares was issued, so it means it remains 150K. And what retained earnings at acquisition? Now we have retained earnings at year end of 700. However, the profit for the year was 200. And I told you, anytime you have to do apportionment or allocation of profit, maybe you need to evenly distribute the profit, you need to assume that the profit is earned also evenly. So which means we're only looking at 6 months post acquisition. So on the date of acquisition, which is already 6 months into the year, we expect that Salter would have made half of that profit. So which means they would have made 100 plus the opening return earnings during the year, because it closed the year with 700 return earnings and the profit for the year is 200. So the opening return earnings must be 500. In addition to these two items, look at note B. It says that the fair value of the asset were equal except for land, which had fair value of 125,000 in excess. So remember, this is a fair value adjustment at acquisition. So which means retained earnings at acquisition will be increased by 125 because net asset will increase by 125. So we have additional net assets from land of 125K. So that's the third items we're having. If we add all of them together, we expect to have net asset opening of 150 plus 600 as 750 plus 125. That is 875,000. So that's the opening net asset. We have that. And now step 4. Is to calculate our opening NCI. Very easy. And that is, they've told us that Hepburn policy is to measure non-controlling interest at fair value. And for this purpose, the share price is 6.5. So we already know that the share price is 6.5. So what's the remaining portion of shares in Hepburn that was not acquired by Hepburn? In Salter that was not acquired by Hepburn. And that is 20% of 150. Remember, Salter has total of 150 shares. 150,000 shares. 80% was acquired by Hepburn, and remaining 20% is for non-controlling interest. So 20% of that 150K gives us 30,000 shares. So that 30,000 shares we need to value at 6.5 that was given. So which means the value of NCI will be 6.5 multiplied by 30K. And that will give us 6.5 times 30K, and that gives us 195,000. So which means opening NCI is 195k. I hope this is really making sense to you. It's as simple as that. Very easy. Just follow the steps. Then we'll go to step 5. Step 5 is about goodwill. You need to calculate goodwill. And because you've done step 2 on consideration, remember step 2, you've done it, it's consideration. We know our NCI, we know our net assets. Then goodwill is super easy because our goodwill will always be the consideration, remember, which is step 2, plus opening NCI, remember, minus net assets at acquisition. Then if there's any impairment, we deduct any impairment. And that will be our goodwill. So the consideration, we already calculated it. We got 900. Plus opening NCI, we got 195. Then the net asset acquired, we got 875. Then we were told that there was an impairment of goodwill by 20,000. That's in D, note D, this one. Okay, so that is minus 20k. So if you calculate all of that, that's 900 plus 195 minus 875 minus 20. And that gives us goodwill of 200,000. And remember that impairment, we'll deal with it also when we're calculating NCI, because NCI has a goodwill because it's measured at fair value. So this impairment of 20, even though the whole of credit is going to goodwill, the debit will have to be split between retained earnings and NCI. Retained earnings at 80%, which is acquisition, and NCI at 20%. So which means this will be 160. This one will take 16k, and this one will take 4k of the impairment. Yeah. And the credit of 20k goes to goodwill. That is why goodwill eventually became 200k, right? So take note, because we're going to use that, right? Okay, so we know goodwill, which is step 5. Now our step 6 is always the template. Very easy. It's template. And to make it easier for you is just to write down what you already have in this. Yeah, and that's what I've listed down here. Remember, we are focusing on statement of financial position. Leave the P&L part, right? Which is PPE, we have investment, we have inventory, we have account receivable, bank, and on the liability side as well, equity, we have all of that. That's all I've listed down here. The same thing. The only thing I've added is just a goodwill, which we will always add, and likewise the NCI, which we always have to add. Now we have step 6, template is ready. Step 7 now is to consolidate. There's nothing you have to do. It's to just start the consolidation, and that is the 5 steps that we have. And the first step is to eliminate investment in subsidiary and the share capital of the subsidiary. Good enough. This question told us that it has not been accounted for before, so which means there is nothing to eliminate, but we need to go to our share capital and record our share capital. And for this one, remember, our share capital opening for the parent is 400. However, it issued more shares to pay for his investment, so we need to account for that. So that will be 400 plus the 300 that goes to share capital, and the share premium. There's no share premium in this question, but because he issued the share of $1 at $3, there's a $2 share premium, and that's why we have share premium of 600. So we are going to have share premium of 600 and share capital of 700. So we dealt with step 1 of our consolidate phase. Step 2 of our consolidate phase is now to do the adjustment items. So we need to deal with the adjustment items, and all of that we'll see in the note, right? We'll see in the note. Note B told us about land, that has a fair value adjustment of 125. So we need to deal with that so that we don't miss it. So let's deal with PPE now. So which means PPE is where the land is. So in our PPE of consolidation, we're going to have we're going to have 620, and we're going to have 660. Then we're going to have additional 125, which is adjustment. So here I'm going to have 620 plus 660 plus 125, and that gives us PPE value of 1405. So we have PPE value. And any other adjustment items, we have intercompany as well. We have intercompany, and we likewise there's an intercompany, and there is a sale. Note C told us there is a sale. So all of that we need to adjust for, right? But let's deal with the easier one. If you look at note E, it said the current account of the two companies disagreed due to a cash remittance of 20,000. So there's cash in transit, and you can see that the Salters debit balance in Epson book was 56,000 before that adjustment. So which means that Salters has a payable to Hepburn. So which means Hepburn is expecting a receivable of 56,000. So which means in Hepburn AR book, there's a 56,000 account receivable from Salter. So which means in that AR, we need to remove that intercompany receivable. So this 170 plus 210, we need to take away the 56 from it. So that will be 170 plus 210 minus 56. And that gives us 324. Then we need to deal with account payable immediately here. In account payable, remember I told you something. I said when there's a cash in transit, you're going to accelerate the delivery of that cash. So which means in AP and bank, we need to accelerate. So let's complete the bank part quickly first. So 20, 40, then addition, that's cash in transit of 20. So for cash, we're going to have 20 plus 40 plus additional 20. And that will give us a bank balance of 80. Then in AP, because this guy believed that he has already sent 20. So the only balance he's going to have in his AP will be 36. Right? So in our AP, we won't remove the whole of 56 because he has already sent out 20, and will be recording just 36 in his book. That's 56 less the 20 that he has sent. So that means our AP will be this 170 plus the 155 minus 36. So that's what we need to do for AP. So that's 170 plus 155 minus 36. And if you put all of that together, that gives us 289 for AP. Right, so that's another adjustment item. So we've accounted for note F, we've seen note E, note D. Now, so let's put Goodwill for note D because we already calculated it to be 200. So that is workings A4, no A5 actually. That's what Goodwill is. That's working A5. We have 200 for Goodwill. Fantastic. So we're doing a very good job. So is to also think about what are the other adjustments. So that's note C. We've not accounted for note C adjustment, which is provision for unearned profit. Let's look at that. So I'll just call this one working C. It's part of our adjustment actually. So let's call it. So adjustment is a step, the second part of our working, but that's step 2, right? So I'll call it working B2. Remember, working A is about 7 steps, working B is about 5 steps. So now adjustment is about so many things. Fair value adjustment is there, provision for unearned profit is there, and other intercompany balances, right, which we've looked at in previous videos. So let's work out the provision for unearned profit. And I know that's pretty straightforward from what we've done before. Notice says in the post-acquisition period, Hepburn sold goods to Salter at price of 100,000. This was calculated to give a markup on cost of 25% to Hepburn. Salter had half of these goods in inventory at the year end. So the whole inventory has not been sold to a third party, which means that when there's unearned profit that we need to adjust for. So now we need to calculate that unearned profit. So for unearned profit, let's calculate that. Yeah, what we know is that sale, which I will call selling price, was 100k, right? And we know that the markup on cost. So remember, when I explained markup to you, I said just look at markup, multiply by selling price. Sorry, multiply by cost of sales. Margin goes with selling price. Markup goes with cost of sales. Right? So markup multiplied by cost of sales is equals to profit. No, we're interested in profit. We know selling price. We know markup, but we don't know cost of sales. Right? But likewise, selling price minus cost of sale is also equals to profit. And we know the selling price. So which means, since we know markup, our markup is 25%. It was given here. Markup 25%. So which means that our profit is equals to 0.25 multiplied by cost of sales. Likewise, profit can also be equals to selling price minus cost of sale. And we know selling price is 100k, yeah, minus cost of sale. So which means profit equals to 100k again minus cost of sale. Invariably, what we are saying that this is equals to this. So if we say those two equations are equals to 0.25 cost of sale is equals to 100k minus cost of sale. So which means 0.25 cost of sales plus cost of sales equals to 100k. And that case, 1.25 cost of sale equals to 100k. And the cost of sale that we are talking about is equals to 100k divided by 1.25. And that gives us a cost of sale of, let's do 100 divided by 1.25 of 80k. So that's cost of sale, 80k. So if cost of sale is 80k and selling price is 100k, then we know our profit. So it means our profit is equals to 100k minus 80k, and that equals to 20k. So on the whole transaction, there is a profit of 20k. However, the question says that only 50% has not been sold, and that is what has not been earned. So this is not earned because it's still within the group. We need to eliminate it, and that will be 50% of the whole profit. So which means unearned profit is equals to 10k. So this 10k, we will have to adjust for it. It's part of adjustment. And you remember how we adjust for it. We're going to adjust for it in inventory and likewise in retained earnings. Yeah, so the entry is always to reduce inventory, credit inventory, and reduce retained earnings. Yeah, by that 10k. Yeah, so which means in our inventory addition, that's another adjustment item that we have to deal with. So if I go back to inventory balance is 240 and 280. Then we need to adjust for unearned profit. So that is 240 plus 280 minus 10k. And that gives us inventory balance of 510. With that, we've dealt with all the adjustment notes that was given to us. Then the remaining thing is to just add up, which is our step 3, add all asset and liability together. So we've done PP. So investment, the investment subsidiary has not been accounted for, so we can easily add the 20 and 10 together to have 30k. Goodwill is done, inventory is done, AR is done, bank is done, share capital, share premium, all done. Retained earnings, we'll come back to it. That is our step 4. NCI is our step 5. We'll come back to it. And so we're done with step 2 and step 3. Now let's go to step 4, which is about retained earnings. So that is working B4. So let's do B4, which is on retained earnings. Remember the way we calculate retained earnings. Pretty easy. What we say is that retained earnings is always the parent retained earnings plus the percentage ownership, of post acquisition profit. And take care of goodwill impairment when it's in the question. So we have goodwill impairment. Okay, now so what's the parent retained earnings? It's clearly given. It's 450. So we have 450 here. Now we need to calculate the post acquisition profit. Remember, we know that it's a 6 months into the year that acquisition took place, when the profit for the whole year is even 200. So at the middle of the year, the profit at that point was 100. So which means the post acquisition profit was actually 100. So which means we're going to have 80% of 100 as a starter, which is equals to 80. That is there. There is an impairment of goodwill, which parent will suffer 80%. It won't suffer everything because the NCI is measured at fair value. So 80% of 20k is the only one is going to suffer. So that will be minus 16. Right? That is there. Then remember provision for unearned profit, which we calculated earlier. We need to also take that off, and that is 10. And all of this should give us our group retained earnings to add to our consolidation. That's 450 plus 80 minus 16, then minus 10. And that gives us a retained earnings of 504. And immediately we have that, we'll plug it straight away in our calculation. Retained earnings 504. And the step 5 is NCI, which is B5, right? So let's work the closing NCI, the closing non-controlling interest. And that one is also easy. The way we do it, we'll start with the opening NCI, which we already have in one of our 7 steps. Our opening NCI, we got it to be 195. If we go back quickly to that 7 steps, we got NCI to be 195 here, remember, right? So after the opening NCI, the next thing is to get the post-acquisition profit. So it's the percentage ownership of post-acquisition profit, just like we did for the parent. And that is 20% of 100, which is equals to 20. Then also, because its measure at fair value is going to take percentage of goodwill impairment, and that is 20% of 20, and that is 4. So we're going to deduct 4 from that. So if we calculate all of that, our closing NCI should be 195 plus 20 minus 4. And that gives 211. So we'll plug that in straight away, and we should be done with our consolidation, because that's our step 5 that we're not done. So let's add everything together. Total asset is 1405 plus 30 plus 200 plus 510 plus 324 plus 80, and that gives 2549 as total asset. The total equity is 600 plus 504 plus 211. That is 1315. Now let me press again. 700 plus 600 plus 504 plus 211. Yeah, 2015. That's 2015. Yeah, more like it, because these are the 13, this 18, and more than 2000. Yeah, cool. So we have total equity of 2015. Then total liability, the venture, we've not added it together, we missed that. So let's add it together. The venture is nil in parent, but 150. Yeah, so that's 0 plus 150 because subsidiary. So this will be 150. Then current tax payable as well, we have 50 and 45. And that's 95. So our total liability is 150 plus 289 plus 95. That gives 534. So if we add 534 and 2015, it gives us the total equity and liability. And that's add up to 2549. Fantastic, and perfectly balances with the total asset.